The 1929 stock market crash triggered the Great Depression, leading to widespread economic hardship, unemployment, and deflation, tackled differently worldwide, including the New Deal in the US. The 1970s experienced oil shocks, causing global economic disruptions and leading to stagflation, influencing a shift to neoliberal policies in the subsequent decade. The crisis in 1997 began with the Thai baht collapse, sparking widespread currency devaluations and financial restructuring in East Asia. The 2008 subprime mortgage crisis, caused by the U.S. housing bubble burst, highlighted the interconnectivity of financial systems, with major institutional failures sparking the Great Recession. This overview underscores the importance of understanding economic resilience. Caleb, if you can get us started, as a financial journalist, what narrative similarities and differences have you observed between these historical economic downturns?
Yeah, great question. And it really shows you how the course of history has changed in terms of globalization, the interconnectedness of markets. It used to be when things would blow up, whether they be in Europe or here in the United States or in other countries, those were a lot more isolated incidents. But of course, over the last 3 or 4 decades, as we become more globalized, there's contagion from one market to the other. The great financial crisis is a good example of that. It wasn't just banks here in the US and mortgage companies, it was European banks that were also underwriting some of this debt, that were also selling some of these products to their customers. So the more connected we got, the more contagion you saw spread throughout financial markets. And ultimately, there was no way to isolate these problems. That is kind of breaking back up again. We're in this deglobalization era. So we'll see if we do have that intermarket, inter-country contagion as much as we used to. And the next crisis, we know one's coming. We just don't know when, and we just don't know what it'll be.
The world certainly feeling smaller, but you bring up a good point that maybe isolationism is changing, like the pendulum swings a little bit.
Yeah,
Chris,
I mean, still half of the companies in the S&P 500 make a lot of their revenue outside the US, and that hasn't changed. But just in terms of where countries and sovereign wealth funds are investing their money, that may be changing a little bit, but we're still very tied together.
It was super interesting during the pandemic because it was global, but it was unfolding just slightly different timelines. I just recall talking to people in the Philippines, in Asia, in Hawaii, and it was all just kind of unfolding at a different time, but it affected all of us. Chris, how do the investment challenges faced by individual investors differ from institutional investors?
Yeah, it's a good question. I mean, when I started my career, I was at TIAA, and our bogey was to stay fully invested all the time. I think we could have 5% cash at most. And when I came into the business, it was 1997. So I went through the Asian financial crisis, and then shortly thereafter, the internet bubble bursting. And I remember my secretary coming to my 2 bosses and I, and we're saying, why is my account going down every day? And we're like, I mean, we have to stay fully invested. We really have very little room to move. So I think I was looking for solutions myself. Luckily, we had our dad who had really developed METV, which is his business cycle model, trying to figure out when is a good time to take risk, when you should be taking less risk, and to avoid those big drawdowns, to avoid a 30% drawdown, a 50% drawdown. And we've taken over that legacy. We don't ever want to go to our clients and say we're just staying fully invested and riding the market down 40-50%. We think that you do have to take action, and you can study business cycle and understand when there are times to be more defensive and more aggressive.
Gary, you've seen different market crashes, different crises. I think one of the challenges that each one's a little bit different. Like there are similarities, but the catalyst is often different. Curious, can you talk a little bit about like I guess, historically, like looking back at some of these crises and things that we can learn, the different lessons.
Sure. And let's take a really long view, because all empires rise and fall, everything fails, but the way they fail is always the same. All empires end with overexpansion, war, and debt. Yeah, it happened with the Roman Empire, it happened with the Spanish, it happened with Great Britain, and we're starting to see examples of extreme stress here in the United States for similar reasons. Worth pointing out that everything the government is doing right now is designed, whether intentionally or not, to make things worse. Currently, massive amounts of government spending is destroying value. We were just talking about this before. The increase in GDP is less than the increase in government debt. And because government spending is additive to GDP, what that means is that government spending actually has negative value and is pushing out private investment. We also see them lying openly about infrastructure investments. We've been talking in this country for decades about a need to renew infrastructure and invest in infrastructure, but the truth is, things don't get built. You could be in environmental review for 10 years. And so what we're doing right now, what our government is doing right now, is they're spending money on consumption and pulling demand forward, and telling us that it's infrastructure investment. It is not. Infrastructure investment are things that we'll all benefit from for decades and will produce basically positive returns. Pulling consumption forward is a completely different story. It's about as advisable as all of us maxing out our credit cards to buy new TVs and buy first class air travel.
The difference is I don't have a printing press in my basement.
Well, so you don't have a printing press in your basement, but let's talk about what this means for a second, because historically the government has financed itself through taxation, and that forced people who had to write their checks, on April 15th or throughout the year to pay their taxes, to really ask hard questions about what's the proper size of government and are these programs worthwhile? And if they didn't like it, they would vote people out and, maybe want bigger or smaller government, but they were part of the decision. Our current government has decided they want to finance themselves through inflation. And that's what they're doing. They're printing money, they're adding to the debt. And the reason they like that is because it's very easy to blame inflation on everybody else. If it's taxes, everyone knows to blame Congress. But if it's not taxes, if it's inflation, they can blame Putin, they can blame supply chain, they can blame COVID, greedy corporations, which of course are only greedy when your party is in the White House and then, the other party complains. But this is what we're seeing. And the reason they like funding it with inflation is because they don't have to make hard choices, right? We can spend on guns, butter, everything. We're well into the bread and circuses part of the show at the moment. And they don't have to make choices. So everything their constituents want, they say, hey, we're getting you more spending. And people think that's terrific and it's free, but it's not. We're all paying for our stimmies through greater inflation.
Caleb, anything to add?
He's not wrong. And I've heard people ask Warren Buffett this question too over the years, and I'm going to be heading out to Omaha next week, and I'm sure he'll come up again. And he would say, well, the follow-on question for investors is, well, what does that mean? For my portfolio, I've been worried about this for a long time. And he would say, you could have been worried about it for the last 50 years, but you would have missed one of the greatest bull markets or several of the greatest bull markets in history if you are not invested. So this is all true. This is the economic paradigm we are in, and it's hard to think about ever getting out of it. There is a moral hazard there. There is the fact that, spending is the only thing sometimes to keep the economy juiced right now. Certainly we needed it in the depth of the pandemic, but arguably we spent way too much money, or the government handed out way too much money after the fact, that it put us in the situation we're in right now. But if you weren't invested during that whole time because you were worried about that, well, you've missed out on incredible returns. And I don't know if you'll see these ever again.
Great point. You can't let your worry keep you out of the market because there's an opportunity cost. But as we talk about the government spending, that's a good segue. We'll go to segment 2.